Welcome to the Explainer. Today we're diving into an accounting rule that sounds technical but is actually super important for understanding a company's real story. It's called International Accounting Standard 10, or IAS 10. And let's just jump right in with a scenario. Okay, so picture this. A company has an amazing year. They close their books on December 31st, everything looks great. But then, in the middle of January, before they've actually published their annual report, disaster strikes. Their main warehouse burns to the ground. So what on earth do you do? Do you pretend it never happened? Because, hey, it was technically in the new year? Or do you have to go back and change the numbers? It's a massive dilemma. And that is precisely where IAS 10 comes in. It gives companies a clear set of rules for how to handle these big events that happen after the year has ended, but before the financial statements are officially out. The whole goal is to make sure the report is truthful without being misleading about when things actually went down. To really get this, we first need to understand the exact time frame that this standard covers. I kind of like to call it the limbo period. So the clock for this limbo period starts ticking right at the end of the reporting period, let's say December 31st. It keeps on ticking while the accountants are busy finalizing everything, and the period officially ends on the date the financial statements are authorized for issue. In our example here, that's February 15th. Any major event that happens between those two dates, well, that falls under the rules of IAS 10. And here's the official definition. You can see it covers both good things and bad things, favorable and unfavorable events that pop up in that window. So this could be anything from landing a huge new contract to, a warehouse fire. So when something happens in this period, the company has to make a critical choice. And this is really the heart of IAS 10. Do you go back and actually adjust the financial numbers, or do you just add a note explaining what happened? And the answer, believe it or not, comes down to one single golden question. This is it, right here. Did the underlying condition that led to this event already exist when the clock struck midnight on December 31st? The answer to this question changes everything. Because the answer to that question splits all these events into two totally different categories. On one side, you have adjusting events, which are for conditions that were already there, and on the other, non-adjusting events, for conditions that are brand new. So let's walk down each of these paths. First up, path 1, adjusting events. And as the name pretty much gives away, this is when you have to go back and physically change the numbers in the financial statements. The official definition says it all. It's an event that gives you new information about a condition that already existed at year-end. You can think of it like finding a missing puzzle piece that just clarifies the picture you already had. So what does this look like in the real world? Well, here are some classic examples. A court case that was already ongoing finally settles. That just confirms a liability you already had. A major customer goes bankrupt in January. Well, that gives you new, crucial information about the value of the money they owed you back on December 31st. Or you find a big mistake. Of course, you got to fix that. In every case, the root cause was already there. Let's make this really concrete. Imagine on December 31st, a company's books show that its customers owe it $500,000. That's the snapshot of their accounts receivable on that day. But then, in January, they get the news that one of those clients who owed them $100,000 has gone bankrupt. Now, since that client was very likely already in financial trouble on December 31st, this new info forces an adjustment. The accounts receivable gets written down, and the company's total assets on the report actually go down. The report is changed to reflect the reality of the situation as it truly was at year-end. Okay, so that was path 1. Now for the other side of the coin. Non-adjusting events. And here, what you have to do is completely different. A non-adjusting event is one where the underlying condition popped up entirely after the reporting date. It's a totally new situation that just did not exist when the books were closed for the year. And our opening example, that warehouse fire, fits perfectly here. A natural disaster that happens in the new year is a textbook non-adjusting event. A sudden stock market crash in January is another. The key is that these events reflect the new year's reality, not the old one. So let's get back to our warehouse fire. On December 31st, that warehouse was standing tall and it was valued on the books at $2 million. Because the fire was a brand new condition that arose in January, you absolutely do not go back and change this number. The December 31st statement has to reflect the reality of that specific day. So what do you do instead? I mean, you can't just ignore it. You don't change the numbers, but
You must add a disclosure in the notes to the financial statements. This note tells investors and anyone else reading the report exactly what happened. It makes them aware of a huge event that's going to impact the company's future, all without rewriting history.
So why is this distinction so important? Why all the fuss? Well, it all really comes down to two simple but powerful words: trust and accuracy. The whole point of a financial report is to give a true picture of the company's position at a very specific moment in time, like the close of business on December 31st. IAS 10 protects the integrity of that snapshot. It makes sure we don't go back and change the past just because of things that happen later. So here it is, the whole logic in 4 simple steps. An event happens, you ask that golden question: did the condition already exist? If the answer is yes, you adjust the numbers. If the answer is no, you just disclose it in the notes. That's the framework. Clear, simple, and really powerful. Now, there is one major exception, a really important caveat here. If a non-adjusting event is so catastrophic that it actually threatens the company's ability to stay in business, what accountants call a going concern issue, then the rules can change. If the basic assumption that the business will continue is no longer true, the entire foundation of the financial statements might have to be rethought. And that leaves us with a final thought. The next time you look at an annual report, check the reporting date, December 31st, maybe. Then think about the date you're actually reading it. IAS 10 is what governs what happens in that initial gap. But it makes you wonder, doesn't it? What else has happened since then that you don't know about yet?